we have these following items. The first thing they said is we should prepare an extract for the statement of profit or loss. Our extract for the statement of profit or loss is going to have the same items. So we're going to have our revenue, which is amounted to 150,000. 150,000 with less cost of sales. Our cost of sales now is, we only have opening inventory and closing inventory. So it's going to be opening inventory. Opening inventory, which is amounted to 36,500, 36,500, and our closing inventory, less closing inventory, which is what? 32,300, 32,300. So this gives us 0, 0, 2. We have 4,200. Are you here? Are you here? We have 4,200. So we take this away to get our gross profit. So our gross profit, 150,000 minus 4,200. That's 0, 0. Here we put 10. And we have 8. 5, 4, 5, 4, 5, 4, 1. So we have 145,800. So these are our gross profits. Now we go back to the formula for mine. They said we have a markup of 20%. This can be our gross profit. Okay, let's assume these are our gross profit now. So we'll go back to the markup. The formula for markup is gross profit. We have it already. Let's look at it. So we have gross profit multiplied by 100 divided by the cost of sales. But our markup here is 20%. So because it is markup, it becomes 120%. So here we could have 120 over 100 equals to gross profit 145,000 divided by our cost of sales. What's our cost of sales? 4,200. 4,200 multiplied by 100. Do we get it? 120 over 120%. Our markup is 20% here, so it is 120%.
No, it's 20%. No.
I told you markup is an increase.
So you
in the basket.
So you increase it to
120. Because it's markup. If there was margin, we reduce it.
Reduce it to how much?
Minus 20, that's 80%.
Oh, minus 20. Yani 20 over 80 means
20 over 100.
Show me how to predict this.
You said we have a markup of 20%. A markup of 20% means an increase of 20%.
120.
120.
Yes.
But if it was margin here,
100 minus
minus 20. Minus 20. Because it's 20%. If they wrote margin of 20%, it would be 100 minus 20 is still problem.
Yes, and
that would be 80%. Instead of 120 here, so instead of 91 because it is markup, we have 120. That is the 100%, the 100 plus 20, making 120%.
yes.
Do you get it?
Yes.
So 120% of the gross profit is what we're going to look for now. This is our gross profit, right? 145,800. But they said we have what? A markup of 20%. So a markup of 20% means that we're talking about 120 over 100 multiplied by 145,800.
Why did you put the 100?
120%.
120%.
Do we get it or not?
For me, I get it, but not like 60%.
This is our gross profit. This is our gross profit, right? So we have a markup of 20% on the gross profit. So the markup of 20% on the gross profit is going to give us our new gross profit. Because there's a markup. So here, 120 over 145,800 will make our gross profit. Do we get it now?
Yes.
Yes, yes.
We have our gross profit to be 145,800. Done.
Yes.
But there's a markup of 20%. So it means that our gross profit should increase by 20%, by 20%. So to increase our gross profit by 20%, it will be 120 over 100, that's 120%. So 120% of 145,800 gives us the increase in the gross profit. So 120 multiplied by this, let's say it's 0, 0, 0, 0. So we have 12 multiplied by 14580. 12 multiplied by 14,580. What does it give you, please? 12,000 multiplied by 14,580.
174,906.
How?
12,000, no, 12 multiplied by
174,960.
174,960. So this is the increment. So how do we get the figure now? This minus this tells us the actual figure that it increases.
How is 12 multiply 12 multiply what?
Do we get it, please?
12 multiply the gross profit, which is 145,000.
No, 14,580. 14,580 multiplied by 12 gives us this.
And 14,000.
Yeah. So this minus this is the increment we're going to estimate to have. Do you get it? So our increment will be this 174,960 minus 145,800. 06143. So 34,160 is the estimate for the future gross profit. Is it clear now?
Yes.
Yes, is it clear?
Yes.
Are you sure?
Yes.
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 What about us?
Negative.
We have our gross profit. I think you know how we got our gross profit here. Gross profit is your cost of sales minus your revenue. How do you get your cost of sales? Your cost of sales are your purchases, your opening inventory, less your closing inventory. But here we don't have purchases. We only have opening inventory and closing inventory. So it means opening inventory minus closing inventory is your cost of sales. So these are our cost of sales. Opening inventory minus closing inventory. This was our cost of sales. Cost of sales minus your revenue gives you your gross profit. So now that we have a gross profit, we have a markup of 20%. A markup of 20% would mean 120%. 120% of gross profit gives us 174,960. So this minus this gives us the increase that we're looking for. Is it clear now? Is it clear?
So 20% of 145, the gross profit.
This is a markup. The markup means you are estimating to have an increase in your revenue for next year. So the difference in the difference in the revenue has increased by 34,160, which you have predicted.
Oh, okay.
Do you get it? We predicted that we're going to have increase of 20% from our gross profit. The increase of 20% from our gross profit is 34,160 because our gross profit is 145,800. That is the prediction. But if we predicted that we're going to have a margin in our gross profit, it would have meant that our revenue would have fallen. 100 minus 20. So instead of having 120 here, you're going to have 80 over 100.
8 times 14580.
8 times 14580. You get it. It will be less. How much is that?
116,360.
116. You see? It's lesser than this now. That is the prediction that it's a margin. So there's going to be a gap between our revenue and the gross profit.